Welcome to the daily update, where I'll go over the action in the market for Monday, June 24th, and then we'll see how things look for Tuesday, June 25th. Had a down day as far as the index is concerned, but we saw the broad market really outperform. There's some profit taking that's been taking place in the mega caps, and there's some kind of scary looking charts that we just want to keep an eye on to see if that's going to end up leading things lower. But we are showing some improvement when we look at some of the negative divergences and some of the internal measures that we follow for the S&P itself. Before I get started, please know that the SPX Investing Program has now launched. It's free for the month of June. You can go in and look around. If you want to know more about the program, there are links below this video and every video that I post. There's also a link that will take you to that website. If you want to talk to me, here's an email address. We can set up a time to have a conversation if that is of interest to you. Let's go back and talk about what happened and then look at the charts. Right at the open, we did have a lower open. The futures were negative. We were drifting down as we approached the open, and prices quickly then rose up above the daily pivot at 54.65. We got above the end change level, so we went positive. We got up to R1 at 54.78, and then we kept going all the way up to R2 at 54.91. That set the high for the day. Then we started to fall back. We went down and then just chopped sideways for a while along R1. Prices then fell back and actually turned negative by going below the unchanged level and the daily pivot. And we were unable to get back to that positive level. The unchanged level now acted as overhead resistance. And we closed at the daily low below S1 at 54.52. So that way, it's not looking all that positive. And we closed at the low and we saw more late day weakness. We were down 0.31%. We're still above average with volume. And we're positive still in the short, intermediate, and long term, but looking kind of vulnerable because the bigger stocks that have really been driving both the NASDAQ 100 and the S&P, they're seeing some profit taking now, where some other mega caps are holding up okay. But what we're watching is if we see some weakness in the mega caps and the broad market is showing some signs of improvement, that could be encouraging. And it's about inflation and interest rates. We are going to get a major report at the end of this week. We'll get the core PCE inflation report. We're also going to get another estimate for GDP. That also has an inflation component as well. And then we want to keep an eye on all the different geopolitical things that are happening. Some comments, mega caps did underperform, but the broader market was actually showed an advance in Monday's session. These negative divergences, they're still there, and we still want to pay attention to them, but they do look like they are improving. There are these subtle signs of strength that are possibly continuing to develop. Now we just have the stochastics on our short-term extreme positive list, so we've been able to work off some of those short-term indicators, and we just have the Sean trend meter on our intermediate term list. So we're not in an extreme positive or considered to be overbought type situation right now. And this has been able to work off with relatively light damage done to the market overall. The Fed scenario is still pretty much the same. They're leaving rates higher for longer because inflation has not been coming down the way they would like. And now it's looking like September, and I did go over that in the weekend video, that the market anyway is starting to lock in this idea that there may be a rate cut in September. But that's just the market trying to front run what the Fed they think the Fed will do. It's like, inflation's a problem, inflation's a problem, inflation's a problem. Okay, so to normal people, we say, okay, they're not going to cut interest rates. But to the market, they're like, they hear the same thing and they're going, rate cut in September. So it's kind of interesting how all that works. And then they're looking at possibly one cut rather than three, but this is going to change. It's either going to happen the way we're seeing it here, or it's going to get pushed further down the road. The dollar was down and interest rates were also down slightly, and that helped give a little support to stocks, but it didn't really help on a closing basis. We closed at 4.25% for the 10-year yield, where we had been at 4.26% after Friday. We're still inverted with the yield curves and have been now for over a couple of years, especially with the 10 to the 2. Sentiment didn't change. We're still negative, and that's some of these negative divergences that have been coming in. We closed at 40 after Friday. There was no change here, even with the slight down day, and we came in at 40 again. We are in a confirmed trend, and for right now, still, that trend is positive because the ADX is above its moving average and both are above 20. With the down day, because we had Friday and Monday, where our bias is now negative, and I switched our momentum over to mixed because we're not sure. We have some negative seasonality. We were very overextended, almost a little too exuberant as far as Nvidia and the high tech stocks. And now some folks are coming in to take some profits. But if we're still maintaining this positive stance, that could end at any time. We didn't have any economic reports in Monday's session, so there's no charts to show you. This is kind of interesting. This is something that I've been following and I talk about on an as-needed basis. This is the Zwag breadth thrust, and these are just the different signals that have been triggered going back to 1945 or since World War II, because that's when it ended. And the latest one that we're working off of was generated last November, on November 3rd. We almost had one recently. And you can see the results going out 1 month, 3 months, 6 months, and then a year. Really, really good returns. We don't really know where it's going to be going out here. And to show you, I brought this chart up again. Here is the last signal that we saw back in November. And this, from my understanding, it stays on the books for a year. We had one last March, and that kind of carried us through the summer. But since we've passed beyond that, that's kind of fallen off. We're still working off of this one now. We came really, really close here with we just missed it by a day or two. And some people say, well, is that close enough? I mean, it's still showing good, solid strength, but it's not an official signal. So it doesn't necessarily count in that regard. But we can still look at this and go, things are looking okay, at least in the bigger picture for right now. This is disconnecting from the rest of the S&P 500. Folks are just throwing a lot of money into call options for S&P 500 stocks, and mainly into the mega cap growth and tech. And this is sometimes when we get to a mania type of situation, not necessarily long term, but more in the short term. It's the cool thing to do. Everybody's talking about it. People that really don't know what they're doing necessarily, this is what they're starting to do. And so we're seeing this massive amount of call volume. These are options, and they increase in value as something goes up. And it's a way to participate without necessarily buying the stock. It requires a lot less money to do that. And this is a really high reading for the time being, where you have the rest of the S&P, it's a little bit more subdued. And then the largest weekly inflow ever into U.S. growth funds. This also includes the mega caps, and there's just a ton of money going into the market currently, and they could be overdoing it. And a lot of times when people that they don't follow the market all that close, they're not, they don't know an awful lot about it. They're just reacting to what has already happened. And sometimes when we get to those points, that's when we're due for a little bit of humble pie to be sent forth. We'll have to see if this money coming in is showing that it's a little bit overdone to the upside. And then the increase here of volatility over a period of time, this is how we make money. This is what we do. This is also, it's what causes us to have a lot of emotions that we would prefer not to have. But this is looking in during an election year and how volatility will increase until we get up into the election time. Because who's going to win? What's going to happen? Is it going to be a split Congress? Is one side or the other going to actually end up doing a clean sweep? Nobody knows at this point. And so this can have a tendency to increase the volatility. And then in December, it seems like we calm down and then get ready for Christmas. Then looking at the probabilities of a recession going back to 1995, where we see the blue dashed line here, they're starting to go back up a little bit after they have been declining. Also with this dark blue line here as well. And then the spread between the two, that's the other chart that I show between the risky and not as risky bonds. That's also going up just a little bit right now. This chart's a little bit hard to read. They don't really define all that well what these things mean. The dashed line is the yield curve, and those have been inverted for quite a while, and they're starting to go back up here. And then all the different economic indicators, that's the blue area, they're showing a little bit of strength. So that would kind of go against going into a recession. And then the yellow area here, I believe, is the spread between the two, because we're still getting a very, very low reading with that. And then looking at the index return, we go back, we start at 100 over here. And if you take Meta, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA, they're the ones that are really leading things higher. They're up 33% going back to December 2023. The S&P's up 15% since that time. And then the rest, the Professor and Marianne of the stock market, they're up, but not up nearly as much, being up 7% year to date when this chart was made. And then the largest outflow from bank loans since October, and I'm not into the October 23 type stuff, but we're seeing some money coming out. And this could mean a little bit of a drain on liquidity into the market. And we want to see more money flowing through to suggest a more stronger economy. Well, this is coming down. Some of that could be with the rising interest rate environment that we've been in. I did find this interesting chart, and this could put some pressure on the market as well, because it did last time. When we start to get into earnings season again, companies have a blackout period where they can't do any buybacks or even announce any buybacks during that time. And we're starting to get into that point again where they can't really announce what they're doing. Doing a share buyback tends to be positive. And if a company announces that, they will often see a nice little uptick in their stock. And from now until into the middle part of July, that's when we could see some pressure on things according to this. And while this blackout period is getting its strongest, and then we'll finally start to trail off as we get into August and then into September again. Looking at our intraday chart, we did have a lower open, but then immediately some kind of a buy program or something came in. We just shot right up to R2, but that didn't last very long. We hit that overhead resistance. We came back down, danced along R1 for quite a while. Then it was later on when we started to break below. We went negative below the unchanged level. Then we dropped below the daily pivot, but then we were not able to get above that other than briefly, and we could not go positive again. And then we saw things trail off and close below S1 going into the close. And nothing really insightful here. We were a little bit more negative when the futures started to trade. And then, of course, we see the same cash market. We're down just slightly now in the initial after hours market session. And we're seeing a little bit of a pullback here when we look at intraday growth to value. The green line is still, the blue line is still on top, but it is declining. We also saw a bit of a pullback after it really thrust up with value. Growth really got hit in Monday's session, where value ended up doing a lot better. We're also seeing the growth to value ratio showing a little bit of weakness here. So we've been kind of watching this as it was going up since the early part of June, and that's been giving us some signs of hope for the S&P going up. Now that we're possibly topping out and this is coming down, that could put the index itself under a little bit more pressure. The end-of-day chart growth was down pretty significant, where value was up, and growth was up less for the mid caps and also up less for the small caps. So when we look at our ratios here, we actually are coming down with the small cap growth to value ratio. We declined with the mid cap growth to value ratio, coming down, but still after we had been breaking out with the S&P growth to value ratio, we've been pulling back since then. So this part is not necessarily looking all that positive for the time being. And we're coming back down when we look at the growth to value ETFs here, but we're still at the top side of the rainbow. And we saw a little bit of a tick up here with discretionary. We also saw staples ticking up as well. So the ratio between the two is now going back down. We weren't seeing an awful lot of strength in the discretionary to staples ratio, but now we're seeing a little bit more weakness. Large cap growth, just want to keep showing this chart because we did set an all-time high and now we've been starting to pull back as there's been some profit taking. And as of right now, this looks like a pullback, not necessarily a reversal, but reversals start off usually as pullbacks. So that's why we want to keep an eye on things. And looking at large cap growth versus small cap growth, we're coming down after setting a high here. And the Wilshire, it's not really falling off a cliff necessarily. It did decline, but coming off of a recent all-time high. We're looking at our trend. The green line is on top. That means that we're positive. The ADX is continuing to go up, and it's above its moving average, and both are above 20. So we're still positive here. We would like to see the green line turn and go back up. And we're seeing pretty much that same thing here in the short-term chart. We're still in a trending environment with the green line showing that we are in a positive trend. We came down from Friday's session based on volume, but my goodness, it was quadruple witching, which maybe it's back to triple witching now, because one of those used to be a thing called single stock futures, which I loved. Like 20 years ago, I thought these would be really cool, but they never took off as far as popularity. But that's where the triple changed to quadruple. And now that those aren't really happening as much, I don't even know if they're happening at all anymore. And that's why I never got involved in them. There just wasn't the volume or the popularity in them. And they're kind of going away if they haven't already gone away. But we were still above average when you look at volume altogether. Here's our weekly chart of sentiment, where this chart just shows that we're in extreme greed territory at 78.73. We also look at this insider transaction ratio, where we're seeing this starting to go back up. If we get above this 26 level, that could start to turn things a little more negative. And this is the insider buying ETF, where it's not really doing all that well now. It's been chopping sideways, but it's still above its 50-day moving average. Here's the other sentiment indicator where we're dropping down. We're getting a reading of 1.2, where we had been a lot higher than that, but it has been declining lately. The Ulcer Index turned up just a little bit, but we're still well below the moving average. We don't have the latest reading from Investors Intelligence yet. That usually comes out about Thursday or so. We did see a tick up on a closing basis with the VIX. We're coming back up to this moving average, and we're also starting to come back up even though we closed off the high with the VIX when we look at the bar chart. The volatility of the VIX is also picking up as we're seeing a little pressure on the S&P. We're going above the moving averages with the bar chart as well as closing above it with the line chart. And the momentum of the VIX continues to be up according to what the MACD is reading. This is back on the table now, the skew index. We were coming up into the red area. We had a really solid up day and we dropped. Now we're starting to come back up into this red area again. Now, just because the last one, we saw a nice upward move, does not necessarily mean, nor does it not mean, that a big up move is going to happen again this time. We don't really know at that point, but we're coming back into the red area where the market is starting to anticipate a big move. The equity put call ratio did decline, possibly after the weekend. So now instead of going up, we're going back down again with our 5 period. This thing is like jumping all over the place these days. We're still showing the volatility risk premium is quite high. That means that there is some fear in the market. We declined with this fear gauge, and we're also declining with this other fear gauge. So we're seeing different measurements that are coming in showing that there's no fear, and then things like the volatility risk premium showing that there is some fear in the market currently. We're seeing some improvement here with the advanced decline line based on price. We have not broken out above this previous high, but we're continuing to go up. Even on a down day for the S&P, we're holding up here based on volume and actually turned up barely. We probably need a magnifying glass to see that, but it did increase slightly. So this internal measure for right now continues to hold up. We're also seeing the new highs versus new lows holding up. We saw an expansion. That was probably that move higher up to R2 that we saw. That's when a lot of new highs were likely generated. Our 5 period, though, is still pretty much flat, and we're trying to turn back up here with our 10 period. And we're turning more positive here. The advanced decline ratio, both the 19 and the 39 day, they're crossing back above 0. Even on a down day, we're seeing some internal strength there. We are turning down a bit with the accumulation distribution, but we're still above the moving average. But we want to keep an eye on this one. We're also declining with the chicken money flow, and the red line is continuing to go down. Again, we want to watch this. This is what the smart money is doing, and we're declining with the chicken oscillator, but we're still positive. This is a little bit more encouraging. The cumulative advanced decline line for the NYSE, we showed this going up. We're bouncing off of the 50-day moving average with our regular NYSE advanced decline line, also bouncing up off the moving average with this other NYSE advanced decline line. So we're seeing some confirmation there and just showing that the broader market was stronger than a lot of the large caps in the S&P and NASDAQ 100. We're also going back up with the common stock advanced decline line for the NYSE and going up as well based on volume. Turning back up with the S&P cumulative advanced decline line based on price, also going up and never really broke down here based on volume. We're seeing some improvement when we look at the S&P and then the NYSE advanced decline line. We're coming back up to the moving average here. So again, this is showing more broad market, at least a little bit of strength, and that it's holding up better for right now. Also seeing some improvement here. The advanced decline line for the NYSE coming back up to the moving average, still advancing above the moving average with the S&P, coming back up to the moving average with the mid caps and advanced, but still below the moving average with the small caps. Our daily chart, we're just kind of coming down. It looks like, okay, are we setting a top? And if we fall back, we'll be watching to see if we're going to hit one of these pivot points. And on the bottom, we were still above average with volume. And we're coming down and no longer extreme in the short-term stochastic, but we're coming down but still extreme in the intermediate as well as the long-term stochastic. And we're still holding up here okay, but we're starting to drop a little bit below our double and triple exponential moving averages based on 20 periods. We want this to at least go sideways and to stay more positive and actually eventually turn back up. If we start to turn down, this could mean that things are turning a bit more negative. But this is encouraging. We're going up with the 20-period moving average. When we just measured the S&P 500, we're going up with the 50 as well as the 200, even with a down day. This advanced after Friday, and it's advancing after Monday as well. We did decline with the force index, but we're still positive, and we're still above the 20-period moving averages. If we do see more follow-through downside, we're going to be watching these levels to see if they provide support. We're no longer extreme with the standard deviations chart. We continue to be in the +2 channel. Intermediate term, we came down with the balance of power, but we're still positive. Still positive with the go, no go. Still looking okay with the highest high value. We're starting to top out a little bit here with the TTM squeeze, but we still remain positive. And we're still above the double and triple exponential moving averages based on 50 periods. We'll be watching this as well. This is more intermediate term, where we're kind of inside these two lines with the 20 period. Well, if we continue to drop here, that could suggest there's a little bit of concern with the intermediate term. And we are turning back down with the ease of movement, even though we're still positive. Pretty much flat with the Arun. We're above zero with the oscillator, so we continue to be positive. This is encouraging as well. The S&P McClellan oscillator is above zero and continuing to advance. We still see this longer-term negative divergence, but the fact that this is going up is helping to see an improvement there. So we're just starting to turn up with the summation index based on price. We're still declining slightly, but at least slowing down based on volume. So these are not necessarily confirming each other. And we just barely crossed above zero with the NYSE McClellan oscillator. And so we're not quite turning up yet because it's really hard to see this. The summation index based on price, it's slowing down and could be beginning to turn. And we're also seeing it just barely start to turn with the NYSE summation index based on volume. This is encouraging too. The Swenlin trading oscillator is above zero and advancing. We're also above zero with volume. Now, you could be a little bit concerned because it seems like, according to this indicator, price is outperforming volume, but the fact that they're improving, even with the S&P declining the last two sessions, that's encouraging for right now. Momentum taking a little bit of a hit here, but still looking positive with the PMO. But when we look at this based on price, we're actually starting to turn up and go above the moving average. We haven't quite done that yet based on volume. We're not seeing the improvement there, at least yet. So when we look at our PMO studies, we're rising with the PMOs that are also rising. We're going up with the buy signals and starting to turn up with the PMLs that are above zero. So this is some of that internal strength that seems to be building, even though we had a down day for the S&P. We continue to be neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. The slope oscillator rolling over, but still positive. When we get above this green line, you could also suggest that we're still extreme positive there. Rolling over with the MACD, this is more intermediate term, but still looking positive. So we're rolling over a bit with all of our different oscillators in the short, intermediate, and long term, but we're still positive. We're above all the plotted moving averages, so those are still intact. And this is encouraging as well. We had a down day with the S&P, and the bullish percent index actually went up. Now, it's not showing any real strength right now, but it is above 50, so that means it's positive. And the fact that it advanced with the S&P going down can also be taken as positive, but we want to see more follow-through to the upside here. And we're ticking up just a little bit and still positive with the NYSE bullish percent index. We came down a bit with the NASDAQ 100, even though we're above 50, so it's positive, but it did decline as we've been seeing some profit taking. The money flow is still positive, but declining. Same thing with the ultimate oscillator. It's still positive, but declining. Coming down a bit here with the vortex, but it's still positive. We're no longer extreme with the RSI 14. That's more intermediate term. The RSI 9 is also no longer extreme. That's more short term. Coming down, but still above an advancing moving average with on-balance volume. And this is encouraging too. When we look inside the S&P, the stocks that are above their 20-period moving averages continues to advance. We're still seeing this negative divergence based on a comparison with price, but the fact that this is going up is encouraging. So we're looking a little bit better here with our study that we're looking at. After we have been showing quite the weakness along the way, the fact that this is going up could be good things for the S&P. We're also above 50 and advancing with those stocks above their 50-day moving average and going back up above the 100-period moving averages, also turning back up with the 200. So even with the down day, this is some internal measures that are suggesting that things are not necessarily falling apart to this point. The copy curve is rolling over a bit, but it's still positive. The Pring bottom fisher, which we didn't hit a bottom here, but it is generating a signal. So, okay, let's just kind of go with that. The Sean trend meter was flat and it's still extreme positive. And we're still negative here. When we look at the Amex, NASDAQ, and NYSE and take a 5-period moving average of the highs minus the lows, we're still negative there. We want to get all of this back up above zero to see more broad market strength. And then looking at the weekly chart of the S&P, we did come down slightly below this R2 level. We closed above it after Friday, and now that we're just a little bit below it, we'll be watching this level to see if it can hold. And we're seeing a little bit of weakness here with the Heikin Ashi, looking at our different trend charts that we use. Also positive, but pointing down with the Kegi chart, or the Renko chart and the 3-line break chart, they are still positive. And we're coming back up with our 150, but not extreme, where we are coming back up as well with the 200 and starting to look extreme there in the longer term. And we're just negative now with the small caps in the intermediate term. Everything else is now turning back positive. We're also still negative in the long term with bonds based on price. No changes with the decision point scorecard. And we saw some nice little, they were all NASDAQ signals in Monday's session. When we saw that upward thrust, the NASDAQ was able to get above 17.7, but then we spent time just going down, down, down from there. And as far as the sectors, energy had a good day after it's been seeing some weakness, as well as utilities and staples. Now, utilities and staples tend to be more defensive, and the fact that they showed some strength is just something we've been keeping an eye on, where the tech sector saw the most negative reaction in Monday's session. And we're coming back and looking positive. When we look at the new highs and new lows for the NYSE, we had been dropping below zero. Now we're starting to come back above zero. And the equal weight is showing some improvement here. So when we look at our ratio, we're actually coming down. When this comes down, that means the equal weight is doing better than the S&P. And that just is because the mega caps have been under some recent pressure. The Dow over the last few sessions has actually been one of the better looking indexes. It's really showing some improvement, and it was up 0.67%. We're still positive with the Elder's Impulse system for the diamonds. And we hit this pivot point here, and that was the top to this point for the NASDAQ. And we've been coming down since, and we were down a little bit over 1%. We're also coming down over 1% with the NASDAQ 100 after getting about at this pivot point. And we continue to be neutral, though, with the Elder's Impulse system for the Qs. The momentum is rolling over, but still positive with the NASDAQ 100. This is another kind of scary-looking chart. I noticed this over the weekend when I was doing the weekly videos. And this could be a little bit scary here. You see, this was last week's bar right here, and we opened and then closed at just about the same point. And sometimes that might suggest a reversal could be happening. We don't know yet. We just want to keep an eye on this, and it's going to take a week for this to actually develop. But I wanted to show this, just meaning that, okay, there could be some weakness coming into the QQQs on a longer term basis when you look at a weekly chart. The small caps were up, but they're just bouncing around in the range they've been in 2024. We continue to be neutral for the small caps with the Elder's Impulse system. Coming back up to the 50-day moving average with the Russell 2000 small caps. Going up is still below 50 with the RSI. The momentum continues to be negative. The mid caps were able to get above their 50-period moving average, but they're still below this pivot point here. They were up 0.64% and have actually remained positive with the Elder's Impulse system when looking at the mid caps. Apple was up 1/3% after seeing some profit taking. We are seeing a recent golden cross here with the overall trend. Tesla was down 1/4% and still in a downtrend. Seeing a little bit more pullback here with Nvidia as it fell 6.68%. Microsoft was down almost 0.5%, but just coming off of recent all-time highs. We were up with Meta, but not setting a new all-time high. Amazon was down 1.86% and still above its 50-day moving average. Google was down 1/4%, just coming off of setting an all-time high. Netflix was down almost 2.5%, but still looking pretty solid on a trend basis. The FANG index, you could also, now this is a daily chart where we hit a top and now we're starting to come down. So you could start to say, maybe this is looking a little scary for right now. Now we could certainly recover from this, and you could possibly draw a trend line right here to see if that is going to end up holding. But for right now, we just want to notice what's happening on the chart. The financial sector was up over 1%, and after seeing some weakness, it's a little bit more positive that this is showing some more strength and moving above its 50-day moving average. We're going back up with our staples to tech ratio, as we saw staples going up and tech going down. We want this to continue to decline to stay more positive on tech. The dollar ended up being up, and we are into about the middle part of the 105 range. And we're seeing a little bit of a slowdown in the deterioration of the relationship between the S&P 500 and the world index, where it had been just really falling with the 10-year correlation, and it's still declining with the 50, but it could be starting to turn back up a bit now. The staples sector, it was up over 1%. We're still showing where the relative strength and the momentum continue to decline. So even though price is going up, we're seeing a little bit of weakness based on this indicator. With the utilities also seeing an overall decline with relative strength and the momentum, even though they did bounce up off of their 50-day moving average. Healthcare was up over 0.5%, still seeing where relative strength and momentum have not turned to go up yet, at least at this time. Energy has so far been able to bounce off its 200-day moving average, but it still has not been able to get above its 50-day moving average. We are seeing an improvement with the green line, which is momentum, as well as the red line, which is relative strength. And relative to the S&P, that's what I'm comparing it to with this indicator. We were down just a little bit here based on the 10-year yield. We were up a little bit based with the 10-year on price. And then looking at our growth to value ratios, well, with the Qs showing some weakness, they're coming back down to the moving average, seeing a little bit of an improvement, but still we have a declining moving average when we look at discretionary to staples. Large cap growth is coming back down to its moving average when compared to large cap value. So with the large caps coming down to the moving average, back down to the moving average with the mid caps, and dropping below the moving average with the small caps. We're still looking okay here with our 19-day advanced decline ratio. We're still above zero based on price and volume. And we had been coming back up with our S&P to utilities ratio with the down day. Now we're starting to come down. And we had been declining, and we're starting to go back up when we look at the staples to S&P ratio. So what's our outlook for Tuesday? We are still positive. These negative divergences are still there, but they're possibly improving, and that's encouraging, at least to this point. Some internal and broad market strength appears to be developing. That's why I have the question mark. Yeah, it's there, but we need to see more follow through, not just a few days of things actually looking better. We're going to get the FHFA Housing Price Index as well as the Case-Shiller Home Price Index and consumer confidence in Tuesday's session. And then the whole geopolitical mess of things that continues to go on every day. Then on Wednesday, not really anything that significant. We're going to get durable goods and then another estimate of GDP in Thursday's session. The big one is going to be Friday with the core PCE coming out. That's the other important inflation gauge and the one that the Fed really likes to look at. And we're going to get consumer confidence. It's kind of the biggest one in Tuesday's session, according to this calendar. And we're neutral to negative across the board with the Dow, S&P, and NASDAQ. This is the week after options expiration, which tends to be down more than up. Tuesday is kind of more or less unchanged, at least when we compare it to how things reacted in 2023. We are coming into a potential time of seasonal weakness where we're starting to come down for the next few sessions. And then it's usually on a seasonal basis where we see a little bit of strength going into the latter part of June. This also suggests that we might see some weakness in the latter part of June before we see a nice little bounce going into the end of the month seasonally. This is a bigger picture look, also showing that we might see a little bit of weakness here as we get into the first part of July. But in the bigger picture, things are still looking positive. And then Tom Bowley still has this in this negative time, and we'll be in that until we get to the 28th of June, where we see more positive seasonality there. And then I just wanted to show this because July is coming up. This just gives you a look at how things on a seasonal basis have played out in July, but I'll be dealing with that more as we get into the month of July. So we're still keeping an eye on the staples and utilities just to see how things are playing out there. We're also keeping an eye on energy and the healthcare sector. The advanced decline lines, they are still weak overall, unless you look at the S&P advanced decline line, but they are showing signs of improvement. Growth to value is back to kind of showing some weakness now, as well as discretionary to staples. They're just not leading things higher currently. And then I just said the QQQ weekly chart looks kind of scary with that, where we opened and closed at about the same point, and now we're declining after that. So we want to keep an eye on that with a bigger picture look. The equity put call ratio is now going, it should be down. Okay. All right. Then looking at our positive signs, the parabolic SAR is positive. And when we look at the group together of our smart money indicators with the accumulation distribution, yeah, we're positive but declining, with the same thing with the Chaikin money flow and the Chaikin oscillator as well. We are seeing an improvement here with these S&P and NYSE McClellan oscillators as well as the summation indexes. Our oscillators are still positive, but showing some weakness. The bullish percent index is above 50 and actually bounced up on a down day. Our Swenlin trading oscillator is looking more positive, but it's outperforming a bit based on price. We'd like to see volume catch up. The money flow is positive but declining, as is the ultimate oscillator and the vortex. The Copic curve is positive, but also rolling over just a little bit. And the Pring bottom fisher is generating a buy signal, even though we're not really hitting a bottom. If anything, we're close to a top. The financial sector is positive, and we're still positive with the momentum for the NASDAQ 100, but declining, as well as the bullish percent index for the NASDAQ 100. So our conclusion, we're positive. These negative divergences, they're still there, but they are improving for right now. We're wondering if we're seeing some rotation as we see the broader market do better. Value's been doing a little bit better. as there's been some profit taking in the large caps and especially in the mega caps. And so we're wondering, is some strength still under the surface starting to develop? In the short term, we're positive, but we're showing some weakness as we're seeing a bit of a pullback here. We'll be watching that 20-period moving average if we see more weakness here. Intermediate term, we're positive, but this is where we're seeing most of the negative divergences, but they are improving. We're wondering about that rotation idea of going from one area into another. And we do see where some strength continues to come into the market. In the long term, we're positive, but we're looking extreme with the 200-period moving average steady. And we're still seeing a negative divergence between the 150 and the 200. Thank you. I really hope you found this helpful. I hope you have a wonderful day, and I will talk to you in the next video.